When the economy is slowing down and doing poorly, that's when we see the best possible interest rates. In the last 3 years, we've seen a decline in interest rates overall. Interest rates have been impacted by a variety of different things. The prior election, this government shutdown that recently happened, that impacts things. In general, mortgage rates are tied to the economy and just how it's performing. When the economy is slowing down and doing poorly, that's when we see the best possible interest rates, because the worse the economy is doing, the better interest rates are going to be because the government wants to stimulate consumer spending. So if you're looking to refinance, I think a lot of people are under the understanding that the only possibility for someone to refinance is just to lower the rate and payment. But they're not thinking about the other factors that go into their monthly budget. And when we talk to our clients, every single person that I talk to says they want to lower the rate and payment. It's understandable. Why would you want to pay a higher mortgage payment when you don't have to? We do a variety of different things, not just lower the rate and payment. We also are able to take a look at how much equity they've gained over the last 5 to 10 years and utilize that to be able to pay off high interest credit cards. And sometimes when we do a combination of lowering the rate and consolidating debt, utilizing our cash out loans, we're able to put them in shorter terms. So I've seen people be able to manage their monthly budget, keep their budget the same or lower, and go into, say, like a 15-year, which cuts their term in half and will save them hundreds of thousands of dollars because of the fact that there is 180 less mortgage payments that they're having to pay because of the term. So there's a lot of options that I think are available to people that they just really don't know about because they think that the only way to refinance is to lower the rate and payment.
In the mortgage industry, we hear a lot of people that want to lower my interest rate. And sometimes that's not the best solution for somebody. We also come across people that have lower rates with a lot of debt. And sometimes what we're able to accomplish is consolidating the debt and reducing the expense on a monthly basis is going to be the answer. The ultimate goal is to keep more money in your pocket. And sometimes the interest rate on your mortgage is a very small factor on your monthly savings. Keep in mind that most of the debt today, they're higher rates, higher payments. So if we were to help someone consolidate those loans, that opens up more money at the end of the month that they can reinvest towards the mortgage and maybe pay it off in half the time. Okay, let's compare two options. One with a rate of 3.25 with $50,000 of credit card debt, and then let's compare the second option at $400,000 loan amount at a rate of 5.75 with no credit card debt. So the first option, you're looking at a rate of 3.25 with the 3.521 APR. The principal and interest payment is $1,740.83. Now we're gonna add the $50,000 of credit card debt that is also costing $1,500 per month. So the total expense on this first scenario is $3,240.83 per month. That's the total cost per month. Now switching over to the second scenario, $400,000 loan amount, rate of 5.75 at 6.064 APR, and a principal and interest payment of $2,334 with 29 cents. Now the difference between the two options, as you can see, is $906.54. Now if someone was to reinvest the $906.54 back into the mortgage as an extra principal payment every month, the mortgage gets paid in 14 years. So this is where sometimes the interest rate doesn't have any impact on getting the mortgage paid off sooner.